Greetings, fellow investors. Welcome back to the Dividend Uncle, your trusted guide through the ebbs and flows of the investment landscape. Today, we're diving into the shifting tides, exploring why sentiment around REIT is transforming from gloom to boom. As always, if you haven't done so, please remember to subscribe to my channel. Only about 30% of my viewers are subscribers, but I am confident we can do much better than that. Okay, let's dive right in. I did a YouTube poll about 1 month apart, on whether investors think that the REITs will be going up from here, or will REIT prices decline going forward. The results cannot be more different. 1 month ago, when the CSOP iEdge S-REIT Index ETF just rebounded from 52-week lows, 60% of respondents think that REITs will decline again, while only 40% of respondents think REITs will continue its recovery. However, the results of the polls last week was a complete reversal. Now, 60% of the respondents think that REIT prices will be going up from here. I think this represents a significant change in market sentiment over a few weeks, and largely driven by a change in interest rate expectations. The changing landscape. The investment landscape is ever changing, and one significant shift we're witnessing is in the sentiment towards REITs. For a considerable period, a dark cloud loomed, casting skepticism on REITs, primarily due to concerns about peaking interest rates. Interest rates, a pivotal player in the world of investments, had been on an upward trajectory. Historically, rising interest rates triggered anxiety among REIT investors as they often correlate with higher borrowing costs, impacting the profitability of REITs. This led to a phase of subdued enthusiasm and negative sentiment surrounding the REIT market. However, recent developments have brought a breath of fresh air. The narrative around interest rates is shifting. There's a growing consensus among experts that we might have witnessed the peak in interest rates. This change is crucial for REITs, as it alleviates concerns about escalating costs and offers a more favorable environment for growth. Since the expectations of future interest rates changed, the CSOP iEdge S-REIT Index ETF has jumped about 10%. Now let's look at the key catalysts for REIT optimism arising from changes in interest rate expectations. 1. Stabilizing borrowing costs. One of the primary concerns for REITs during times of rising interest rates is the impact on borrowing costs. REITs are inherently highly leveraged vehicles. As interest rates climb, the cost of financing through debt also increases, potentially squeezing profit margins for REITs. However, with the prospect of stabilizing interest rates, REITs can breathe a sigh of relief. Consider CDL Hospitality Trust, with ticker J85, which specializes in hospitality assets including hotels and student accommodation. Over the past year, it faced challenges as interest rates inched higher, affecting the cost of its debt. Investors were especially concerned about management's deliberate decision to hedge only 50% of its debt to fixed rates, which is the lowest among the Singapore REITs. Now, with the anticipation of stable interest rates, CDL Hospitality Trust can refinance its debt at more favorable terms, reducing overall financing expenses and supporting profitability. 2. Income stability. For income-focused investors, stability in earnings is crucial. The uncertainty associated with fluctuating interest rates can make it challenging for REITs to provide reliable and predictable income. A more stable interest rate environment allows REITs to outline clearer financial projections and enhance their ability to maintain consistent distributions. For Keppel DC REIT, with ticker IBU, its ability to provide steady dividend payouts was potentially affected when interest rates were on the rise. Its interest rate expenses jumped by almost 60% in Q3 2023, resulting in its distribution per unit dropping by 3.6%. The management struggled to assure investors of consistent income. Now, as interest rates stabilize, Keppel DC REIT can provide more assurance regarding its ability to sustain its attractive dividend yield. 3. Attractiveness of dividend yields. In a world where the attractiveness of income-generating assets are often based on comparing against treasury yields, REITs have faced headwinds in a rising rate environment. With the so-called risk-free rate at close to 4%, investors have less reasons to invest in REITs with lower dividend yields. As interest rates stabilize or even decline, the yield on REITs becomes more compelling for income-seeking investors who are exploring alternatives to bonds and other fixed-income instruments. Recall that Parkway Life REIT, with ticker C2PU, traditionally has one of the lowest yields among Singapore REITs, of 4% or less. It operates a portfolio of healthcare facilities with fixed rental escalations tied to the consumer price indices. Many investors found themselves with the dilemma of why not just invest in risk-free treasuries. With the recent shift in interest rate sentiment, Parkway Life REIT becomes an attractive option for investors seeking stable income. Its healthy dividend yield, backed by the stability of its rental structure, positions it as a favorable choice in a changing investment landscape. Investor considerations. While the changing dynamics of interest rates paint an optimistic picture for REITs, investors should approach with caution. Not all REITs respond the same way to interest rate fluctuations, and thorough due diligence is essential. Consider the track record of management, the quality of the underlying assets, and the overall economic outlook. Informed decisions today pave the way for a more prosperous investment journey tomorrow. If you found today's discussion insightful, don't forget to give it a thumbs up, share it with your fellow investors, and hit that subscribe button for more timely insights. Drop your thoughts or questions in the comments, and, as always, stay tuned for more in-depth explorations into the dynamic world of dividends and investments. Until next time, happy investing in the changing tide of REITs.